Welcome back. In this video, we'll continue talking about Chapter 12, determining the financing mix. There's no mini exercise associated with this video. We left off starting to talk about leverage, financial leverage, and we saw that more debt means more risk, right? Firms with more leverage have more financial risk. And so from there, we'll move on to ask the question, like, some optimal amount of leverage that a firm should have, right? Because we know that borrowing money involves taking on more risk. Is it worth it? That's kind of what we're getting at here. And if you think back to Chapter 9, when we computed a firm's cost of capital, we average cost of capital. Remember the capital structure weights, the market value weights, right? Give the percentage of the firm's financing that comes from bonds, debt, and also from common stock. Okay. One way to approach it as well, if I can change those capital structure weights in a way that reduces the cost of capital, reduces the WACC, that's going to be better for the owners of a corporation. Because if you think of a firm as like a set of positive NPV projects, right? A set of projects, right? Whether they're different retail stores or different product lines, whatever. These projects, if we can lower the discount rate, the cost of capital on the cash flows associated with all those projects, that will make each of the NPVs of the respective projects higher. That's better for shareholders. So there's these two famous finance researchers who developed these theoretical articles about capital structure. And I'll admit, this part of the chapter is a little bit sort of theoretical and a little dry at times. I'm trying to distill it down here, this content, to the things that I think are the most important and relevant. If you want to go into more detail about any of this, feel free to get in touch. I'm happy to talk more about it. The two things I want you to take away from this video are how tax deductibility of bond interest affects firms' choice of their capital structure, right? How bond interest tax deductibility affects how much leverage firms want to have, and then also how bankruptcy costs affect a firm's use of leverage and the ideal capital structure. So let's look at the first one first. Right? So firms can pay bond interest with pre-tax dollars. Let's illustrate that with an income statement in real life. So I've got our list of publicly traded U.S. companies on Blackboard that we could use as fodder for Guess the Ticker. I've chosen Lowe's companies, retailer, Lowe's, competitor with Home Depot. Let's guess their ticker, the Lowe's companies. Lowe's, it's L-O-W. Did you get it? Anyway, we'll pull up their financial statements and we can see that Lowe's has leverage in their capital structure. They finance some of their operations with borrowed money. And because of that, interest expense. In the most recent 4 quarters, they paid almost $700 million of interest expense, right? And that's a pre-tax expense, right? So it reduces taxable income. So firms with leverage pay less in taxes. Lowe's saves some money on taxes, hundreds of millions of dollars on taxes, by virtue of having this pre-tax, right, this tax deductible interest expense. So that's valuable. And by that, the tax savings from financing part of your operations with debt. Okay, we can use this equation. So here, this first term is kind of like the interest rate on the firm's bonds, and then D is the amount of debt the firm has. Multiplying these two together will give us a figure like an annual interest expense, like we saw on Lowe's income statement just now. If you multiply that by the tax rate, you'll get the tax savings. Let's show that with an example. So here's a firm, $200 million of bonds, and the interest rate or the cost of debt is 9%. And then here's the tax rate. So I got the formula here as well. And let's solve this together. So these first two terms, if we take 0.09 times $200 million. So this firm pays $18 million in interest per year. That reduces taxable income. For every $1 of interest expense, because their tax rate is 40%, every $1 of interest expense reduces their tax bill by 40 cents, because you save like 40 cents on the dollar in taxes for every $1 of interest expense. Okay, so to figure out how much this firm saves altogether by virtue of having this $200 million worth of debt, just multiply it by the tax rate, like the formula says, And so this firm saves $18 million per year in taxes by virtue of this debt that has a 9% interest rate. Okay. So one way to quantify the interest tax savings is through this formula, which is pretty straightforward. Okay. So first takeaway is on the tax deductibility of bond interest. All right. So maybe we'll rate it here. This makes bond interest tax deductibility makes leverage more attractive, right? One of the takeaways for this video. If I can save money on taxes, that I might want more leverage. Might want to borrow more money, other things equal. So you see how this thing affects how much firms want to borrow money, how they choose their capital structure. All right, let's move on and talk about the second thing, bankruptcy costs. All right, when a firm can't pay its debts, it goes bankrupt. In real life, more leverage is associated with a higher probability of bankruptcy. And when a firm goes bankrupt, creditors like bondholders take control of a corporation from shareholders. And in real life, there's costs associated with that. Attorneys get paid a lot of money to work on bankruptcies. If a firm has to liquidate its assets in connection with going bankrupt, there's usually a big loss of value. Like when Toys R Us went bankrupt, they liquidated a lot of inventory, and I'm sure they sold it for way less than its market value, those toys. And even if a firm's not bankrupt, being close to bankrupt is associated, there's costs associated with that, right? If a firm's managers are thinking, oh, we're not focusing on positive NPV projects this week, we're focusing on just like scraping enough cash together just to make one interest payment that we need to make, or else we'll go bankrupt. My first job out of college, I moved to New York to get a job in finance. Remember, I didn't know what investment banking was, so I didn't get a job in finance for a little while. But it was at Gateway Computers, my first job out of college. And they had a network of retail stores, a computer retailer. Remember, they had the boxes with the Holstein prints on them. Anyway, when I was working there, Gateway went into financial distress because they had this huge network of retail stores that at the time I was employed there, buying a personal computer was becoming less and less scary, and people were comfortable buying them online. So they have this huge network of retail stores, and people stopped buying computers from Gateway in person because the retail stores made the computers more expensive. And so when I was an employee at Gateway, towards the end, I wasn't thinking about how to like maximize profit at the store that I was working at. I was looking for jobs while I was at work because the firm was in danger of going bankrupt. It was in financial distress. So as firms have more leverage, right, these bankruptcy and financial distress costs become greater because bankruptcy becomes incrementally more likely. So hopefully that makes sense. As firms borrow more money, bankruptcy becomes a little more likely, and so these costs become greater. So let's go back and put in that other point, right? Bankruptcy costs and financial distress costs make leverage less attractive. Okay, so these two forces kind of work in opposite directions, you can see. And what we end up with is sort of like a trade-off theory where firms sort of trade off the tax benefits of leverage and then the additional bankruptcy costs. And so sometimes we see like a U-shaped cost of capital function where, oh, let's add leverage and save money on taxes until the point where our cost of capital is minimized. And then if we add more leverage, then bankruptcy costs start to outweigh the tax benefits. So we can see that in some real life industries. If we look at average leverage ratios for different industries, one thing I want to highlight is that, first of all, there's a lot of variation, right? And then some of these industries with higher leverage maybe have lower bankruptcy costs because, for example, in an airline, when an airline goes bankrupt, their main asset is the fleet of aircraft, right? So an airplane is an asset that can be repurposed pretty easily when a firm goes bankrupt. You repaint the plane, and it goes back out there and does the same job for a new airline. Compare that to like a software company or an online retailer, something like this, where most of their assets are intangible, right? The coding knowledge of the employees, for example. Software company goes bankrupt, most of its assets can't be like liquidated all that easily because they're intangible. And so I think bankruptcy costs are much higher in software compared with airlines. And so that's one rationale for why we might see much less leverage at software companies compared to airlines, because bankruptcy costs are just so much higher. So the main things to take away from this video were the trade-off between tax benefits and bankruptcy costs in terms of, firms choosing the optimal capital structure, how much leverage to use. Like I said, there's a lot more to this. If you'd like to spend more time on it, feel free to get in touch and I'm happy to talk more. But thanks for tuning in. We'll see you in the next video.